Hello, welcome to Todd Miller TV. I want to talk today about what's going on in San Bernardino County, California, and something that the local government there has decided to potentially do. They've actually taken steps to do it. They formed a committee, and they're being advised sort of to do this by some other parties. And there's a huge debate going and how this is probably the worst thing they could do. It's probably a terrible decision. They're doing it obviously in their own self-interest, and we're going to go through the details of it, explain it, and why I think it's a really bad idea. Okay, so essentially what it involves is something called eminent domain, and eminent domain is the ability for a government to basically seize an asset of some kind for the public good. So for example, in public domain they could take your house because they need to build a park there, or they want to build a freeway. They can physically come in and say, we think it's worth this, we're going to give you this much money, move out. And they do this all the time. There's a lot of debate when they do it, but usually they win. They have the legal right for public good. Okay? So what they're doing this time is for the public good, they're going to go ahead and throw some banks out of the mortgage. They're actually going to seize the mortgage based on the public good, and this is how they're going to do it. Okay? So imagine a person a bunch of years ago bought a house for $300,000. That was the market value. So that's what their mortgage is based on. And they have a monthly payment of $2,000 a month. Okay? And current value is only $100,000. Well, what a lot of people have done is they've gone and gotten loan mods or refis, or they've tried to sort of work this out. But in some cases they haven't. So what the government has decided is they want to prevent foreclosure. So what they're going to do, and they're saying, well, these people are probably going to get foreclosed on. And not only that, they're paying $2,000 a month, but someone else who just bought the house is making a much lower payment. So they're taking all this money that could be spent in the local economy and they're throwing it at the bank. So what we're going to do is we're going to force a refinance here. So one of the things is they have to be current on their payments. Okay? So what they're going to do is they're going to go in and they're going to provide a new mortgage. So they're going to go and say, hey, the house is probably only worth $100,000. We're going to issue a mortgage for $100,000. We're going to send $100,000 to the bank and say, the debt is relieved, this is all it's worth, this is what you're getting. So basically they're going to force the bank to take a $200,000 loss. They're going to put new financing in place and tell the owners of the house, they're going to say, hey, guess what? We just did you a great favor. Since your house is only worth $100,000, you only owe $100,000, and you've got this now new mortgage payment of $700. And what their logic is they prevented a foreclosure because the house won't get foreclosed. And instead of paying $2,000 a month, they're only paying $700 a month. So what this allows is $1,300 more a month that they're going to hope will get spent in their market. So basically what their whole plan is to divert money going outside their market to the bank and basically screw the bank, and then take $1,300 more a month to be spent in the marketplace. Okay, so that's the gist of what they're doing. They've been told this is all legal, and who knows? This will get litigated. But there are some problems with this, and I'm going to go through the problems first. And so you might be the homeowner thinking, hey, this is a great idea. Okay, but there are some problems. First problem is who says the house is only worth $100,000? I mean, they're obviously going to maybe get an appraisal or something like that. So there's going to be an issue with determining the actual value, because someone's getting a windfall here. Okay, maybe it's the homeowner getting out of $200,000 worth of debt. That's going to be a problem. The second problem is going to be an economic problem in the marketplace. And here's the problem. If they're doing this in a market and you're a lender, would you loan in this market? I mean, if you were originating loans in San Bernardino County and this policy showed up, why would you originate a loan? What would happen if the values dropped short term and the government just said, forget it, we're going to throw your loan out and give you pay you 30 cents on the dollar and throw you out of the deal? You're just out. Remember, these people are current on their payments. The bank is getting $2,000 a month and they're just going to throw them out of the deal. The bank's then going to have to write off all that value and take the loss. So what do you think is going to happen? One of two things. Either one, banks will stop lending in that marketplace, and if they do that, it's become a cash market and all the values are going to drop. Okay? So that means current people who have mortgages, the values are going to drop. They're going to be even more underwater. The second problem is that anytime you have a cash market like that, and values drop, people who own the house free and clear are now going to get hurt. Because say somebody just bought a house for $100,000 and now the lending stops in there, values continue to drop, now houses are worth even less, the people who actually pay cash for houses are going to get hurt. So you're going to punish. This is not a freebie. There are no freebies in life. There's an old saying, there's no such thing as a free lunch. Well, this isn't going to be a free lunch. It's going to get paid for somehow, okay? Another problem is this is actually going to hurt banks, and some banks and lenders will go away and interest rates are going to go up. It's going to happen. Okay. Another thing, the bank will find a way to pass on the loss to you. So you have car loans and other things at this bank, adjustable rate loans and things like that. And because they're taking a loss in California of $200,000, being forced to by the government, when the homeowner is current on the payment, they're going to say, fine. Next month, when we adjust the rates on auto loans, they're going to go up 0.5%. So you're going to pay for it. You're either going to get paid less money on your savings, which is probably very little right now. You're going to pay more for consumer and other debt. The bank is going to find a way to make you, the consumer, pay for what the government's doing in San Bernardino County. Another problem is the bank might come out to the borrower and say, hey, Mr. Borrower, you owe us the difference. You got a loan for $300,000. We only got $100,000. You still owe us $200,000. So imagine this: if the government gets some judgment against you, and then every time you try to get a tax return, they have a lien on you, personal lien. They get it maybe from the IRS or somebody else, or they go to your employer and go, this person owes us money. We never foreclosed on the house, so we can take an action against them, and the action is that they put 25% against all your earnings and force you to pay this back. That could happen. The other thing is they could go after your credit. Now remember, some of these people are current on their payments even though they're upside down because they want their credit to be good. So what will happen is the bank will go in and go, well, they stopped making their mortgage payment. To us, we don't recognize the $100,000 as full repayment, so they'll start hammering your credit. And you know it's very difficult to dispute that because they're going to come back and say, wait, we have a thing saying you're supposed to pay your mortgage, you're not paying it. So this all around, this is a bad idea. I'm going to put a link to to some of the articles underneath this blog post. You're going to have to go to toddmillertv.com because I'm not going to, it probably won't work if I put the link on YouTube. For some articles, but this is a new development. The big problem with this is you're saying, yeah, but Todd, this is San Bernardino County. You're in Vegas. I mean, how could this potentially affect us in Las Vegas or in other parts of the country? And this is how. Usually when a municipality does something, other ones adopt it. They sort of say, hey, they're doing that, let's do that too. Because if they're benefiting from it, maybe the local government's benefiting, maybe we'll benefit from it too. So if this comes over to Vegas, this could be terrible. Because all the same reasons. Loans would stop, prices would drop, it would just be terrible. Terrible policy. Anytime a government gets involved, it's usually not good. We saw that a little bit with AB 284, which potentially is going to cause problems here, more so than it is now. The government stepping in here to interfere with the free market in the mortgage lending is going to be very bad for San Bernardino County. If you live in the county, the last thing you want is to let your government start taking over things. Because next thing, what stops that from just taking your house and paying you off and saying, we're going to throw you out of the house because we're going to put somebody else in it at whatever. So anyway, I think this is a terrible idea. It's probably one of the worst ones I've heard yet for a government solution to foreclosure. And here's the biggest thing of all. They're not preventing a foreclosure because these people are current on the payments. People who are behind on their payments who've stopped paying, they're not going to go in and do anything to those people. They're just going to let those houses be foreclosed. This really doesn't prevent foreclosures. This is just a way for them to put in a new bank or a new private lender in there to have those payments diverted to them. It's government interference. I think it's a terrible idea, and so I thought you should be aware of what's going on here. Anyway, that is my update for today, and I hope to see you on another video. Thanks.